Hey guys, Fuel Fields here. Today we're going to be going over the portfolio for the week. Apologies for last video. I had some mic settings that were changed, so I think the recording was pretty quiet. So it should be much better now around this time. Hopefully it's not too loud, but yeah, if it is, obviously it's easier to control the volume down than it is up. So just let me know if this is better than the last video. But starting off for this week, we can go over to the heat map for this S&P 500, and you can see it's kind of a mixed bag. Most of the industrials, energy, a lot of the healthcare is red. There's a few heavy hitters in there that, as a whole, that did well, like ABGO, Google, Meta, and some others. But overall, it's like kind of a choppy week. The S&P 500 did decent for this week. If I hop over here, you can see that this last week it did 0.34% up. So nothing like crazy, but it did better than my portfolio for this week. For the M1 Finance especially, we're almost down 1%. But what I'm really excited about is that our Composer portfolio actually beat it this week, which is super cool. You can see that we're at 0.44% for the 7 days, and for 30 days we're also beating it. But again, a lot of these metrics that are downwards are a little bit harder to measure because we've been kind of hopping a lot of different strategies, or symphonies. But I will get into that in a second. Let me show this real quick. So we ended off beating the S&P 500 in November. You can see that the S&P 500 was sitting around 0.28%, whereas ours is our total portfolio, that is, at 1.95%. Now, if we look at the Composer, we just barely broke even on that. But again, we had a few things that we changed around in November, so somewhat expected. But if we go back to the total portfolio, we can keep looking into that. So for December, so far we're being beat by almost 1% by SPY, which is a little bit annoying. Another thing I kind of forgot to think about, and this is still a little bit new for me because I haven't really been in the algorithmic trading space for that long, but it's wash sales. So that's something I'm probably going to try to do next year. To do it this year, I don't think I'm quite ready yet, as well as I'm not, there's not going to be that many tax implications because I only started halfway through the year anyways. Still more than, I'd like, but I think what my plan is just to do with the next year, which I think the common strategy in this community is to stop trading tickers that you normally trade for the whole month of December. So it's basically, let's say I were to do it a couple days ago, maybe in the 2nd or 1st of December, and then wait 31 days, I believe, and then I can go back into those. Now, it's not to say that you have to be completely sold out. I think the way it works is you can't have bought a ticker that has close to identical returns, or not even just returns, but also the intent of that ticker in 30 days to claim the losses on your tax for a tax deduction purpose, sort of thing. So yeah, like I said, you can kind of hear it from my understanding. It's a little bit mixed. I think that's mostly right. But again, this is assuming that, we're trading the same ticker, because what ends up happening is if you don't wait those 30 days, then it keeps kind of stacking and stacking and stacking. It doesn't get applied until after that. So if we just do that for the entire year without doing any waiting or sitting out periods, basically those losses keep stacking, and they're not eligible for for a tax implication. So anyhow, outside of that, I don't think I'm going to be changing anything different for this year. Like I said, the only thing I probably have on the docket is just that I'm going to try to limit myself to staying the same strategy starting in January 1st for at least 3 months. So whatever I stick with before then, like let's say on the 31st of December, that's going to be the last day that I have to change my strategy. And if I get in a strategy that sucks, it really does suck. I'm going to do everything in my power to kind of keep it that way. Obviously, that might be a good or bad thing, but the idea here is to not really put my mind so much focused on it, because I've been doing that. I've been saying, oh, this strategy has better returns. It's very easy to get wound up in that. So I'm trying to stay far away from that kind of mindset and just stick with what I pick. And in addition to that, kind of revolving around that, I guess, is basically just having more faith in the strategy that I pick, and more so doing more research on that specific strategy. It doesn't also have to be just a single strategy, but a subset of strategies is just what I'm trying to do. So, for the week, we've done pretty well. I think all of our strategies are up for the week. You can see all of them are up positively. I'll get into the stats in a second, but yeah, pretty good. So if I come over here and go to live, and let me do, let's see, 2025. Well, let me see. Yeah, let's do just from, I guess it would be the first. I'll just do the 30th here. You can see that we're up about 0.84% on this one for like the last week. So that's pretty nice. Actually, let's see if I can do it here. I think so. Yeah, okay. So, and let me see if I need to, no, that should be good. So you can see that there's two strategies that are around 4% improvement, which I don't. Here's what I'm going to do. I'm going to open IC stats real quick, because I know that that's more of a collective thing. So this is kind of the entire performance. You can see here that we're up since starting 20% on these. But going back to this, I guess for the week, the TQQQ for the whole the long run, aka FTLT, as well as the Holy Grail, are both up around 4% for the week. Super nice. You have the simple QQQ lever, which is something I made a long time ago. This one's up about 1.35% for the week. I believe that's the same as QQQ. If we go like here, yeah. And then you have this one, I think. I just don't see it on here. But let me do this real quick. This one, we're up 1.28%. This is very similar to this one as well. This one's a little bit lagging behind because we've kind of been in that choppy period. It doesn't do exceptionally well in that. The time it does the most well in is either bull runs or bear runs. So like, because it basically it's kind of like a rotator in a sense. So yeah, let me go back to IC stats, and I can kind of show you the risk analysis as well on each of these. So you can see here that they're all in the really nice risk zone. You can see simple QQQ is literally like, I don't even think this goes lower than 1. It goes down to 0. But you can see it's almost identical, and the reason for that is mostly because the reason for this compared to, honestly, these other ones here is more so that the underlying ticker, because all of these have held the same, I'm pretty sure, since the 20th of November. That price between the back test and the time it is now is basically the difference that we've had. Basically just the time that we bought it essentially is the only difference there. So that's why these are so low. The correlations are almost 1.0 to all of them. This one has the most tickers involved out of all of these, actually. So that's why it's not completely 1.0, my guess. You can see that here. There's like literally only a day where it really straight off. With this range concise thing, you can see that it's not correlated like 100%, but roughly speaking, it's pretty much the same. So what's interesting though is that our return difference is almost 1% actually over the backtest. So we're actually doing better than the backtest. Again, it's not really something to brag about because this could completely flop on the other opposite side where we're down 1%. I care most about the risk score, the tracking error, the correlation, all these other columns. This is just there for an easy one-to-one kind of view of it. But overall, I'm going to stick into this, stick with this still. I think this performs, very well. If it performs anything like this going forward, I'd be very happy because you can see that the annualized return is 62.4% with only a max drawdown of 11.3% going all the way back to 2007. So I'm super happy with that. The Sharpe ratio is 3.15. And also, if you go to OOS on this, because this was like around October 20th, so a little bit over, just a little bit less, than a month past when we started getting into it. You can see it's done very well. It's up 4.6%, whereas SPY is up 0.9%, and QQQ is actually down 0.1%. So overall, very nice, and the Sharpe ratio kind of shows that as well. The thing is, this, if we go back to October 30th on this one, we're probably going to see some better numbers. That's interesting. No, that makes sense because this probably held TQQQ for the most of the time. And so because QQQ is down, this, is roughly speaking close to that, but 3 times. So that makes sense. And then there's this one, which probably performs really similar. This is just a version of that one I just had pulled up just with all the markets you can see. So if I have that here, it's probably just a little bit less. So yeah, kind of takes a nice balance between DJI, or you can see it here, DIA, IWM, QQQ, SPY. So moving on past these, we can see here that the M1 Finance portfolio for last week is down a little bit. But if we go into this real quick, utilities took the biggest hit. I kind of touched on that earlier at the start of the video, but Duke Energy down almost 6%. Southern Company down almost 5.5%. Consumer staples, biggest loser there is Coca-Cola. Forgot what it was. There was some news on Coca-Cola just recently, but some weird marketing thing, I think. I don't quite remember what it was, but and last but not least, on the loser side, consumer staples. Consumer discretionary. Costco's still losing. Unfortunately, it's been really not that well. I'll get into that a little bit later when we touch on the holdings, but in terms of the highest growth, we have financials, Morgan Stanley up 4%, super nice. We have real estate, which the biggest one there is Realty Income Corporation, and semiconductors, biggest one there was NVIDIA. So that's actually interesting. Why does this show? Oh, I was on one day. My bad. I need to fix my bookmark. But yeah, you can see this is actually pretty much the same as what the week showed. But yeah. So heading on over here to the performance tab. And we can see this from this. It was up. It was up on Friday, but it went down 2.65%. I think there was a day in there where, like midday, I think it was I don't remember which one it was. I think it might have been Monday, where this was actually up like almost 20%. It was crazy, but yeah, this is super volatile. One of these days it is going to collapse, MSTR that is, and this is going to be very great. But until then, again, I'm not like holding my breath on this. And to close out the video, to go into earnings, there is some earnings next week. The main one for me is AVGO, Costco, but mostly AVGO. And in fact, what I forgot to touch on, which I said I was going to touch on, is the holdings. But real quick, let me go over the dividends that we got. I believe that Visa one is new. Yeah, so we had the Visa one for $1.54, and then Honeywell for $4.11. Going into holdings, though, the highest one we have there is AMD at 98%. We have Google at 95% and AVGO at 72%. All really nice. If you go down, though, we have AMT at negative 11%, Procter & Gamble at negative almost 9%, and then Costco at 7.5% or 7.7% down. Really sucks, but really not much we can do, obviously. I mean, we could get out of them, but I don't want to do that. So, yeah, I would say, yeah, I'm not really looking to change anything for these. I'm very happy with my picks. Obviously, we're still up, if we go back to this, 16% since starting. And this is unrealized gain, which is something I didn't really compute, because I believe this means, because it's unrealized gain, it's not the gains that we got from the dividends earlier. So this means that we've gone up 16.5% since around March, because I believe that's when we put most of these in, which is actually pretty good. If you annualize that, that's pretty good. It's almost like 20% annualized, I think. But yeah, but I think that's it for this week. No big changes in my portfolio. It's going to be another week until the next contribution. Then it's going to be the holidays. That is something that I did want to bring up, actually, which is the S&P. It's the S&P return, like monthly returns. There is a chart here that includes like 2025. If we just open the image in the new tabs, you can see, oh, that is terrible. I want to show this. Well, we can see it from this chart. It's just a little bit difficult. December is typically a very good month because you have a lot of consumer spending. Obviously from stuff like, for Christmas, for example. This is maybe a better one. This goes to 2021, but you get the idea. This goes all the way back to 1928. So, but basically, what we get out of this is really nice returns where we can expect, hopefully, returns to be high this month. It's the very beginning, so it's not done like exceptionally well. I mean, we're up 0.34%, but I do expect it to do better than most months. Like, I think this is like, you can see, at least according to this graph, I think this is probably like the second or third highest month typically. So we'll see, because obviously there's years that kind of break that trend, such as November here was actually supposed to be like decently high, but it was actually pretty low. Obviously, a lot of stuff depends on the news and stuff. But anyways, I'm going to quit rambling. But yeah, looking forward to the next week. And as always, guys, I wish you guys well in the future.